I don't think we know. I don't think we have the right answers. I think the most important thing we can do is just be humble and Bayesian about this entire process and understand that, hey, we're probably going through regime change. Some of the things that we're used to doing are probably going to continue to work. Some of the things that we're used to doing are probably going to stop working. But it's very important for us to be very, present and open and honest about that process in real time so that we can do less of what's, going to stop working and do more of what's going to continue to work.
Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager, due diligence, or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we'll have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Kostrup Larsen.
A new world order is emerging, and in our Global Macro series, I, along with my co-host, Jem Kazan, want to dig deep into the minds of some of the most prominent experts to help us better understand what this new global macro-driven world may look like. We want to explore their perspectives on a host of game-changing issues and hopefully dig out nuances in their work through meaningful conversations. Our guest today is someone who combines the world of global macro with a rigorous data-driven framework when it comes to macro risk management frameworks as well as processes. He's a frequent guest on many of the well-known media outlets and, like us, has a deep passion for helping investors navigate this uncertain environment by sharing lots of actionable research that you can understand. So please enjoy our conversation with Darius Dale. Darius, welcome and thank you so much for joining Jem and I today for what I'm sure will be a fun, passionate, and perhaps unpredictable conversation as part of our Global Macro series. How are both of you guys doing? How are things where you are?
I'm so blessed, man. Thanks for having me. A really big fan of the show, so I can't wait to unpack it with you guys. Yeah.
What about you, Jem? Where are you?
Well, Darius interviewed me maybe 6 months ago, so I'm excited to kind of return the favor. This should be a lot of fun.
You absolutely nailed that interview, by the way, and the market call. So congratulations.
Well, so no pressure.
So let me just say, for a little bit of housekeeping here, we have a little bit of audio problems with Jem. That's why he may sound a little bit different, but I'm sure the words that he speaks will be very familiar. But anyways, Darius, it's all about you today. And since it's your first time on our podcast, perhaps I could ask you to just set the stage and provide a little bit of context for our conversation by maybe sharing some of the highlights and perhaps maybe some of the unusual twists and turns in your journey to where you are today. And then I think that's going to be useful for our listeners. And then we'll go into lots of different macro topics, of course.
Yeah, absolutely. So I'll start by saying I'm a macro strategist or macro risk manager by trade. Certainly was not anything that I thought I would be doing for a living. Going back to school, I went to Yale and as an undergrad and joined finance sort of right at the lows of the industry. I was very fortunate at the time to go work at a startup firm called Hedge Risk Management, which is now no longer a startup. We helped grow that firm to a pretty big size firm, but I would say my sort of core contribution to that firm and probably why I'm sitting here today was sort of, kind of recreating a very, very watered down version of Bridgewater's sort of all weather system as an asset allocation framework, for the hedge eye clients, and sort of been thinking about the world through this regime segmentation lens ever since then. Sort of left hedge eye. I did leave hedge eye at about a year and a half ago to start 42 Macro. I thought there's a lot of different things that I could do better and do differently, and ultimately call the shots on my own. And knock on wood, things are going quite well in that regard.
Yeah, no, absolutely. And of course, everybody should go and check out Darius's work and also a little bit more about his background, because it is quite interesting and people should certainly be aware of that. maybe as a starting point, maybe we could talk a little bit about your current macro framework, but I want to put a twist to it a little bit, and that is maybe you could also talk about how it may have changed in the last 6 to 12 months, just so we know, how strongly or how weakly the current convictions are held compared to what the markets have been doing for the last year or so.
Yeah, no, great question, Neil. So I'm a big believer in studying the time series and respecting the x-axis. So it's a great question to give the listeners context on kind of where we've been. So as I mentioned, we look at the world through this regime segmentation lens. We sort of we call it the grid. Grid is short for Goldilocks, reflation, inflation, and deflation. Whereby Goldilocks is growth accelerating, inflation decelerating. Reflation is where both growth and inflation are trending higher simultaneously. Inflation, which is where we've been really since July of 2021, is where growth is trending lower and inflation is trending higher. And it's our current view that in the month of August, we're transitioning to deflation, which is where growth and inflation are trending lower. We've been in this sort of very high probability sort of realized inflation regime in terms of the size of the magnitude of the deceleration in growth that we've observed, the size of the magnitude of the accelerations in inflation we've observed. But we're now kind of transitioning to a regime where we're going to see a little bit less expediency, if you will, on both of those fronts, particularly on the growth front, which may be slightly positive for the markets.
Yeah, what a timing to be recording this a day after we saw the first glimmer of hope for the deflationary camp. Absolutely. I want to. There are so many things we're going to talk about today, and it's kind of hard to decide where to start. But for my part, I wouldn't mind about starting maybe with the bigger picture, kind of what I think you refer to as your kind of strategic perspective. And kind of the transitioning maybe from the world of deflation as we knew it for 2, almost 3 decades, and maybe to a world where inflation is not just going to be a thing of the last 12 months, but actually a thing of quite a while, even though it may come in different shapes and sizes. So what is your kind of view strategically at this point?
Yeah, no, that's a great question. And I like your emphasis on strategically, because, what we just talked about was really the kind of the shorter term cycles that, tend to drive the markets from a dispersion perspective. But from a strategic standpoint, I think it's very important to step back and kind of identify that there has been a regime shift with respect to the direction of travel for the trend inflation rate. We've been trending lower really since the early 80s. And sort of ultimately made the lowest lows kind of in the GFC and kind of retested some of those lows, pick your indicator, in 2020. It's very likely, at least according to our models, we've built a pretty sophisticated model to project the long run trend in things like core PCE, et cetera. And that model is had a pretty significant inflection. And it's suggestive that we might see core PCE, for instance, trend at a rate that's around 60 to 110 basis points higher than its trend in the prior decade. Now, that doesn't sound like a lot, but when you do it in percentage terms, you're talking about 40 to 70% more inflation through the lens of the Fed's preferred inflation gauge. And oh, by the way, consistently and persistently trending higher than their target. And so that kind of opens up a Pandora's box of a lot of different scenarios from asset markets. On the bullish side of the ledger, we're talking about an economy that likely has higher potential nominal growth, an economy that, for a variety of reasons, not the least of which is deglobalization is both a bullish and bearish factor in some respects. But we're also talking about, just a Federal Reserve that might be acquiescent to that and not push back. It's very well, the history is littered with, these sort of inflationary episodes where you go from a regime where there's less inflation to a higher inflation. You're talking like the 40s or the 70s, and the central bank's willingness to acquiesce to that may be a big factor in understanding how that ultimately impacts the economy and asset markets. If you put a gun to my head, I think the Fed really is going to be forced with a very difficult choice in this decade, which is, do you save the economy and the stock market by effectively acknowledging that there's this, kind of, 40 to 70% more inflation in the pipeline that has to come through, or else what? Or else we kind of go into a depression? Or do you sort of, save the bond market by consistently and persistently pushing back against that pressure and trying to maintain a 2% target? I don't know the answer to that, but to me, I think that's the biggest question we investors kind of face from a strategic asset allocation perspective.
Yeah, no, I'm sure we're going to talk a lot about that. And of course, I live in a country with tight gun controls. I would never put a gun to your head. On the other hand, Jim lives in Chicago.
We don't.
Take it away, Jim.
Wow. Yeah, I'll put a gun to your head.
Thank you, Jim.
So we can talk about, slightly higher trending inflation over the long run. And I think that's, I think my views, but I think that's a pretty safe bet given structural trends. But the real question for me is, path A, how do we get there? Because, we could obviously go to 10% inflation and then go to deflation, right? And end up in that average, right? There's a lot of different paths to get there. I think in particular, we're at like you said, an inflection point, and the probably, the distribution of outcomes, as you and I have talked about in the past, is very leptokurtic, and you can have lots of different potential outcomes. I'd be curious to think what you think the most likely path is. I'd really like to start with kind of 3 to 6 months, which is always hard, right? That's always the hardest. 6 to 12 months, and then, out 2 to 5 years. What do you think? And again, everybody's trying to prognosticate these things. It's not easy. A lot of it depends on reaction functions, et cetera. But I'd like to hear your thoughts on where your head's at currently with inflation, where you think it's going, what path.
Yeah, so let's start with a great question, Jim. We'll start with the medium term, sort of like how we think about the medium term as 3 to 6 months. It's sort of different than kind of the traditional economists would think about it. But from that perspective, and if you asked me this question, by the way, 2 days ago, my answer would be very different. We got some very important economic signals out of yesterday's CPI. Obviously, it was a very positive report in the sense that, we surprised consensus estimates to the downside by a significant degree on both headline and core. But to me, that's kind of the sideshow. The real juice in the report came via the lens of the Cleveland Fed's median CPI statistic and the Atlanta Fed's sticky CPI statistic. And the reason that those are two important indicators is because they tend to track core PCE, which is the Fed's preferred inflation gauge, quite closely. We saw, if you analyze the time series on a month-over-month annualized basis, we're talking about significant decelerations that historically we have not seen outside of recession. So median CPI decelerated 250 basis points to 6.3% month-over-month annualized, and sticky CPI decelerated 270 basis points to 5.4% month-over-month annualized. These are, it's again, as I can't stress enough how unusual it is to see the kind of breakdowns we're seeing in these types of indicators. And the key takeaway here is that if you roll this kind of momentum forward, over the next couple of months, and again, I'm not saying you could, or even there's even a basis to do so, but if we did see this kind of sustained breakdown over the next few months, we could be talking about observing 2 to 2.5% core PCE on a month-over-month annualized basis as early as August or September. And to me, so that's a very new and a very important piece of new information that we Bayesians have to just humbly accept as part of the new market narrative. So from an inflation standpoint, it's our model's view, and again, these kinds of things are almost impossible to model. But just if you try to model the trend in the time series, it's very likely that we continue to decelerate. It's unlikely that we see this kind of pace of breakdown continue. But if it does, and again, I would have argued that it's unlikely we even saw it in the July report, but we did see it. So we have to acknowledge that there's something happening in the time series and on the ground that is anomalous relative to history. And if that anomalous thing relative to history continues, we could be talking about a much different inflation dynamic 3 to 6 months from now than the one we're currently talking about.
So I'm actually going to dive in before you go into a longer time series and push back a little bit, because that just makes for a better conversation. It's really to be polemical here, but if you look at the CPI report and you dig under the hood, which I know you do in great detail, the real reason this number came in low was energy, right? I mean, that's the overwhelming reason. There are other factors, to be clear, and I'd love to hear your thoughts if you disagree. But that's what I see. And energy was month over month down 4.6. Some of the internals like fuel were down 11%. Right? I mean, we saw dramatic effects via energy, and then knock-on effects because of that as well. And we kind of knew that, right? Just obviously, we knew it'd be a major issue here, but it was decelerated dramatically more than we even thought. And so, as the Fed would say, that's the reason they separate core from the rest. Those things can change quickly, and hard to say what affects. China invades Taiwan tomorrow. That may change things. If we have changes in policy from Russia, that can change things quickly. So given that, how much credence should we be giving CPI and the deceleration here? Love to hear your thoughts there.
Great question. And let me be clear, just even before I answer the question, just for the listeners, we are at a very, very interesting time right now in the economy and asset markets. Nothing that we say in this podcast or anyone saying anyone talking at this particular juncture should have a lot of certainty. Again, as Jim mentioned, I think the range of outcomes economically and by extension from the perspective of asset markets is quite flat right now, and it's a very wide distribution, which is very unlike what we saw at the beginning of the year when I thought the range of outcomes was actually quite narrow. We were going to slow pretty precipitously, and the markets are going to have a problem with that. It's a much more two-sided bidirectional risk from that perspective now. But kind of answering your question. So yes, energy was a very significant drag on the overall time series, and certainly played a role in the decline in things like median CPI. But you can't deny the improvement we saw in sticky CPI, of which energy is going to have a very low impact on that. And more importantly, we saw a pretty substantial deceleration on core services CPI. We saw that come down 150 basis points on a 3-month annualized basis to 6.7%. Now those numbers are they're more than double the kind of trend rate we've observed pre-COVID, and so we're still very much not out of the woods. But it's just I think the number one thing I really want to focus on is the fact that we're seeing this kind of improvement without seeing the kind of drawdown in aggregate demand you typically need to see this kind of improvement on inflation. It's very clear that to kind of tip the cap to the team transitory, which was very wrong last year. It may be the case that both the transitory camp and the persistent camp are right at different intervals. The persistent camp was very right in calling for the incremental surge in inflation going back to last fall. But it could be the case that if we observe this kind of breakdown in inflation, and again, it's a broad-based breakdown across core goods, core services, median CPI, sticky CPI. If we see this kind of broad-based breakdown continue in the ensuing months, then team transitory will ultimately be proven right. So that's kind of the nature of markets. It's not about whether you're a bull or a bear. It's about the timing with which you buy and sell securities and exposures. That's all that matters.
I just want to add one thing. I want to let Jim continue down his path, but I just want to say one thing about this inflation and what's going on right now, because it's only been a couple of months ago, I think, that Powell came out saying that there are two parts of the whole inflation picture, energy and food, we don't control. That's why we look at core CPI. And oddly enough, exactly after that speech or whenever he made that comment, those two things have just headed south, dramatically. And we know that, in particular, oil is being massively manipulated by in my opinion, very risky strategy by the White House in terms of releasing so much of the strategic petroleum reserves because of elections, in my opinion. But of course, we knew that especially in energy markets, a million barrel here or there can really make a huge difference because with commodities, it's very, very here and now demand and supply that determines the price. So I also caution this as, let's not celebrate too much right now. It's one number, and we know things have been manipulated in recent months. And I guess from my perspective, maybe we'll talk about this more about later. I think we're into this new regime in terms of just inflation. I mean, inflation as a whole, I think we can see much more unpredictable sort of trends in inflation, which will make it very hard for any economist or commentator to make much sense of this. And I also think this will then, allow markets to be much more volatile than what we've seen in the past. But anyways, that's a side note. I want you, Jim, to continue down the path of where you were heading.
Yeah. So now this is where I really put a gun to your head is, 3 to 6 months, again, who knows, we can make broad, but, as we go further and further out, this is where your conviction, right? Where you see the path of things really kind of shaking out. And I think kind of comes in, let's talk 6 months to 12 months. So let's extend it kind of a little bit further. Again, I know that's not your primary, you're really talking to people about quick moving changes and what that might mean for shifting from, one regime segment to another. But really, I'm sure you do think about the big picture quite a bit. I'd love to hear your thoughts, about 6 to 12 and then longer term, and then why. Obviously, how do you feel that way and why?
Yeah, great question. So just as an aside, at 42 Macro, most of our, sort of risk management investment horizon is focused on the rolling 3 to 6 month forward time horizon. We definitely have, very informed views on sort of the 6 to 12 month horizon. But, generally speaking, in terms of, how we've orchestrated our back test, it tends to be the case that the markets are only pricing in things like the rate of change of growth, inflation, inflections in policy on usually no more than 3 months forward. Things like, is a company going bankrupt or not? Those things tend to be much more longer lead times in terms of market response. But so anyway, just kind of focusing on the 6 to 12 month forward view, I don't think we're too dissimilar from the consensus, which is calling for a pretty significant deceleration in inflation, particularly when you get out 6 to 12 months. That's when you really start to see the breakdown in the time series momentum. Now, the one thing I think that is pretty interesting is if you look at our model on inflation, it's now starting to call for, let's call it a June, a bottom, of June of 2023 bottom at, a pretty elevated level, just shy of 4%. Now, again, that's very path dependent. If we don't get the kind of continued breakdown we see, we just observe in the July CPI data on, some of the things on that lead core PCE, we're going to continue to see a Fed that's very much, actively engaged in removing liquidity from the economy and financial markets. And as a function of that, we're going to see a more significantly negative growth slowdown in the first half of next year, which will ultimately lower that entire curve. So again, answering everything today is based on how the world is currently set up today, just from a Bayesian prior standpoint. So, kind of to answer your question, or sorry, not to answer your question, but to me, I think the most important dynamic in that whole process is inflation could be bottoming at a level that is very inconsistent with the Fed's 2% target on a year-over-year rate of change basis, which implies that, if we don't sustain the kind of breakdown again in annualized momentum, then we're talking about a Fed policy setting that's going to be significantly more tight throughout 2023 than what is currently priced into money markets, Eurodollar futures, Fed fund futures, et cetera. And so to me, as I mentioned, I think the key takeaway from this discussion is like, hey, look, the distribution of outcomes is extremely wide. It's a very credible case to seeing a Fed that is significantly more tight than what consensus is currently pricing in. And also a very credible case to seeing a Fed that is way more dovish in 1 to 2 months than what is currently priced in. And so to me, I think it makes the game hard, but ultimately you got to make a bet if you want to make money in financial markets.
So I think 6 to 12 month is the toughest, right? I would agree with that 100%. It's easy to see the deflationary effects that you'd expect from the Fed accelerating off its low here. And any other time, again, we don't have a lot of inflationary history in the last 40 years. But if you go back to the 60s and 70s and prior, when we did have inflationary periods, the Fed does have the ability to slow growth, as we know, by raising rates, and they always do. The question is how much can they and how much is structural, and ultimately at what point Does that structural inflation meet decline in growth to a point where they're not willing, they have to choose, right? And so where is that structural level of inflation is important, kind of like you highlighted. And at the end of the day, if that's going to be higher, and how high is a question, right? At some point, you start to get maybe, and we've seen this in the past, people starting to lose faith in the Fed's ability to control inflation. I think that's what we may start to see 6, 12 months out or so. I think that's the big question, at least, is are we going to bottom at a higher structural level of inflation that people expect or that's being currently priced? And what does that mean for long-term inflation expectations that the Fed can then control? Right now, they're able to control those long-term inflation expectations. I mean, it's pretty impressive if you think we're at 8.5% CPI, right? And we're pricing 10-year break-evens around 2.5, right? That's, that we're basically looking back at the last 40 years and saying, hey, we're going to be just slightly higher than the last, 40 years on average. And again, that's what I think the base case is for people. But that assumes that the last 40 years is where we live now, and not in some other period, if you ask me. And so I do think that's the toughest time. So given that, let's now transition to long term. Do you, based on your views, do you think the Fed controls things here, and then ultimately gets the world back on track in the next year or two to where we were in the last, where we've essentially been for the last 40 years?
Yeah, so that's a loaded question. Loaded question. 2 guns, by the way, we're counting against my head. So for those of you keeping score at home. Anyway, the third thing I'll say is that I very much agree with you, not to make boring TV, that we're going to bottom at a level of inflation that is unacceptable relative to not both the Fed's mandate, but also to recent trends. It's very likely, however, that along that path to getting there, the markets are going to eventually price in the full recovery. And at some point, we're probably going to have to unwind some portion of the market pricing in that full decline back towards 2% inflation. Fun fact, the Fed is forecasting core PCE, which is currently at 4.8% year over year, to end 2023 at 2.7%, which implies obviously a deceleration of 210 basis points. Never in the history of that time series have we seen that kind of decline over that sort of period of time without going through a recession, without having had a recession first. So, so it's interesting to say, it's interesting to say the least that, if we get that kind of decline in inflation, will we need to see a recession to do it? I was certainly in the camp that we were going to have to get a recession. And part of the reason for that was that it became very clear, listening to the Fed's statements, particularly Powell's statements in May, and then again in June, that this is a Fed that is increasingly comfortable with, delivering economic downturn, an actual recession, to get inflation under control. And knowing what we know about core PCE, it's like you're going to have to get an you're going to have to have an inflation recession to get to achieve your inflation objectives. That may no longer be the case. Certainly, the most recent data we got out of this July CPI report would seem to create a new avenue for that debate. So we certainly have to acknowledge that as market participants. Going back to kind of the longer term, inflation dynamic, there's a lot of different things pushing and pulling the inflation, the stationary mean of inflation higher, not the least of which is globalization, aging. I forget the guest, Niels, you had on the podcast a few weeks ago, who wrote the paper on the structural aging factors. That's one of the factors in our structural inflation model. And so if you're talking about inflation, let's use the high end of that range. It's somewhere around 2.8% for core PCE. If the Fed wants to. And so what are they going to do about that 80 basis points? Is if we can't get back down to that 80 basis points, is the Fed's policy setting going to be, just way too tight for way too long of a period of time for most of this decade, because they're kicking and screaming, trying to get it back to 2. Or I think is equally as relevant is they opt to sort of acknowledge that and opt to sort of, maybe they do it under the guise of a green transition or green inflation or something, where they effectively, revise their inflation target higher. I mean, they've already done it, right? They did it back in August of 2020 by, effectively saying it's an average inflation target and we're going to stay as easy as possible until we achieve our employment mandate. That was, big code word for, we're going to let inflation run hot. And so we've seen kind of the first step in that direction. So it's not inconceivable that, we see a couple incremental steps in the direction of, acknowledging that there's just going to be more inflation. We got to deal with it. And if that's the case, then this is a bond market that is, egregiously overpriced from that perspective. And the reason I say that is that, we're still talking about term premium. If you look at 10-year term premium, somewhere minus 70 basis points, at the highs of the inflation episode in the 70s. And by the way, I'm not saying this is the 70s. I do not think it is the 70s, to be very clear. But at the high, just kind of giving you some bands of outcomes, you can have term premium as wide as, 300-400 basis points on the 10-year treasury. Now, again, I don't think we're going there, but you could go from minus 70 to plus 100. And that's a very different bond market than the one we've come out of. And it's a very different asset mix from the perspective of sector and style factor dispersion in the equity and credit markets, right? And so to me, I think that's a real key question here. And part of the reason why you might see an expansion in term premium for those who are kind of not as into the weeds on bond math, but you're talking about a higher level of inflation. Higher inflation creates more inflation volatility, creates more economic volatility, and all things being equal on the policy rate, et cetera. You do need to price in higher risk premium into the asset class. And if you price a higher risk premium into the asset class in the treasury market, obviously you're going to be talking about pricing in wider risk premium across the curve. But ultimately, I do think that a Fed that acknowledges a higher level of inflation with easier policy is likely to be positive for risk assets.
I think you touched on a very important point on we can talk about whether the 2-year, and this is kind of why I broke up the time period, being correct. But the amount of risk premia that's, where the 10-year is priced, right, relative to the risks, right, at hand, does seem inefficient or mispriced. I guess mispriced is always a dangerous word, but and let me tell you let me throw in a little bit of history, and I'm sure you know this, but just for our listeners, the last time we had real secular or structural inflation, obviously 60s and 70s. I hate to just refer to that period because, like you said, every period's different, but things rhyme. And if you look at what the Fed did in the 60s and 70s, William McChesney Martin, lowered interest rates raised interest rates 7.5%. The Fed funds rate, which people don't remember, in 68 and 69, to fight inflation, caused a very mild recession in 68, 69. But it was enough to bring rates down over that 2-year period from 5.5%, 6% all the way down to about 3%. It leveled off at 3% and then took off when they stopped and pivoted. Right, it took off to 10%. And the reasons why that are now relatively well documented. These are structural effects, many of which we actually share in common. And I think that's an important thing to note. So we could, and we're likely, if they do cause a recession, if they continue down this path, and they're not even close to 7.5%, to be clear. Nobody's expecting them at this point to go 7.5%. But that's what he did in order to cause a very mild recession because the demand push was so strong during that period. And on the back of the Great Society program from LBJ, a lot of fiscal policy, et cetera, a lot of things that we're seeing now. But at the end of the day, it leveled. They couldn't get it down to 2% or below. The economy was in recession, so they stopped and pivoted, and that's when long-term inflation inflation ticked higher, and then long-term inflation expectations pivoted higher, and that's what started to create this massive decade-long problem. After that, people think Arthur Burns was asleep at the wheel. Arthur Burns raised Fed funds rate 10.5%. Again, we're talking about 3%, 4%, et cetera. 10.5%. People still refer to him as one of the major reasons for why inflation took hold and was alive until Volcker had to step in. That's not actually true. There was structural underlying inflation, and a lot of which, again, if you just look at the factors, I'm not trying to say this is the same period, the structural causes of that, ultimately, a lot of them were the same things that we're experiencing now. So again, just a little history lesson, which I think is important for people to refer to and think about as what has the Fed done in the past? What does that mean? Yes, they're absolutely able to cause a recession and lower rates in the short to medium term, call it 1 year, 2 year, et cetera, period. The question is when that recession hits, are they going to continue at that point to be, hawkish? And history says that they can't politically, and they won't. And
they won't.
Yeah, they won't. And if they're not, the question then becomes, what then? And I think that point is what's important about this 2 year versus 10-year risk premium, that people are kind of not pricing in equivalent. Everybody's talking about inflation in this general sense, but I think where and when and the timeline is incredibly important at this point, and particularly as we talk about kind of duration, 10 years out or so, which is actually the lowest spot that we're seeing, out there on the curve.
Yeah, I masterclass, by the way. Thank you for elucidating us on kind of, some of these dynamics in the 70s, because I agree with you. And I myself am guilty of this, of just sort of labeling Arthur Burns as this guy who let the inflation genie out of the bottle. Obviously, it could be argued, and I will argue that there's a lot more that he could have done to stamp out inflation. It just wasn't politically correct and feasible at the time. You obviously had President Carter, President Nixon obviously leaning very, very aggressively against him, against those kinds of policies. And so it just, I think he took he took the road of trying to have the cake and eat it too, which I fear that this Jay Powell Fed may ultimately want to opt for, which is you want to get inflation down, but you also don't want to kill the economy. And eventually what you're going to wind up doing is having stagflation as the only outcome. If you tighten just enough to slow a little bit, but you don't tighten enough to get rid of inflation, stagflation is really the modal outcome of that policy mix. And so this is kind of the issue, kind of longer term for asset markets is the Fed going to allow the process of returning inflation back to trend, however quickly it may take? Again, as I mentioned, we could be looking at month-on-month annualized rates of core PCE at 2.5% by September. Or it could be we don't get there any point in time, or we don't sustain that at any point in time in the next several years. Again, as I mentioned, the distribution of outcomes is quite wide, and each of those scenarios needs to be sort of accounted for in your portfolio construction to the very least. So yeah, I would tend to agree with that. One other thing I would call out is that if you look at 10-year inflation swap rates, which, you can look at TIPS break-evens. Some people don't like break-evens because, the Fed's leaning on the TIPS market. So it just goes straight to the source. We're talking about 10-year inflation swap rates at 2.7%. And so, the upper end of our range for our core PCE model is 2.8%. And historically, there's been this 50 basis point spread between headline CPI and core PCE. This thing's mispriced by 60 basis points today. Even at the peak or just rolling off the peak of a very significant inflation episode. And so to me, I think there's going to be a lot of, if we move into this era of higher inflation, which I would argue we already are in, and it's persistent, there's a lot of institutional asset allocators that are going to be dragged into this regime kicking and screaming, unfortunately. And so it just is what it is. It goes back to the question that I think of the decade, which is, does the Fed save the bond market, or does it save the economy and the stock market? I think the worst possible outcome is if it tries to do both.
Yeah, I think the last thing I'd say about this before we kind of move on is credibility, right? The Fed has credibility, at least with the market from the last 40 years, and they're pushing the market around as they tend to do. What happened in the 60s and 70s is the market lost credibility in the Fed. And that was primarily, I would argue, because of structural factors that they could not control. And so, the question is that the case? And if we get there, again, next year or so, year two, you start to see, the market realize that the Fed may not be able to control this. That's when things get, in my opinion, very interesting. And can lead to major regime change, decade-long effects. And as we know, if you get that direction right, as people, who have the last 40 years, you're going to make a lot of money. Hard thing to get right. But I think, as you mentioned, mispriced. Last question for you as related to this: what's the trade? How would you position And that's always kind of where does the rubber meet the road? Do you have any trades in particular that you like, given that?
Yeah. So, I mean, I think I would say, let me start by saying, I fancy myself a macro risk manager. And the number one goal of a macro risk manager is to not lose money, is to help investors compound returns and avoid drawdowns while doing it. You're probably not going to, in a raging bull market of 1999 or 2021, you're probably not going to outperform listening to folks like myself. But over time, what your goal is to compound returns and have a higher, adjusted net value, some years in the future as a function of not having to suffer the kind of geometric return decay that you tend to see. I think volatility drag is the appropriate term for that. Go look it up for those who are not aware of that. Anyway, so kind of what's the trade from my perspective? I think as I mentioned, there are sort of three core scenarios that I think need to be reasonably allocated to across, an investment portfolio. There's this sort of base case scenario, which is, growth is likely to continue to slow as a function of the lagged impact of the accumulated tightening we've seen to date. And it's likely that inflation slows, but perhaps not at the same pace that we saw and observed in this breakdown in July CPI. That trade says you can be long risk, but you certainly want to be favoring defensive sectors, style factors within the equity and credit markets. You probably don't want to be too far out on the risk spectrum as it relates to digital assets, because that is inherently a more unstable environment than an environment in which growth is accelerating and the Fed is kind of adding to the liquidity function in the economy, the Fed and Treasury combined. So that's sort of the base case scenario. Kind of long risk, defensive oriented style risks. The bull case scenario, which we talked about, is a scenario in which the market is significantly breaking down, or not the market, but inflation rather. Inflation pressure is significantly breaking down on a month-over-month annualized basis, and if that continues, we're talking about a Fed that by November 2nd is very much done with rate hikes, and talking about maybe revising its balance sheet, the pace of its balance sheet withdrawal. And more importantly, I think it's less to do with quantitative tightening as it relates to net liquidity. In that environment, if we did see that, you're talking about $2 trillion of excess liquidity sitting in the reverse repo facility that would become de facto QE if applied to asset markets, if given the green light by the Federal Reserve. And so it could very much overwhelm the Fed's quantitative tightening program if we achieve some of these sort of more, I would say, best case scenario outcomes with respect to inflation. And so that obviously needs to be allocated to, because again, it's no longer this kind of distant possibility. The data is telling you this is a legitimate potentiality. And so that obviously favors being even more longer of risk. Again, as long as growth is continuing to slow, you're generally going to want to favor defensive sectors and style factors. But the one caveat to that is that, and this is, I think, the hardest part of getting the trade right today, which is if inflation does continue to slow at that pace, which again is a massive if. There's not a lot of time series history to suggest it should and could. But if it does, you might actually start to see a reacceleration in growth. Because again, what it ultimately implies is that maybe the Fed's policy setting was not as restrictive as we all thought it was after all, and that this economy is, still has a ton of potential to continue growing gangbusters. You've talked about on the program, Jim, that there's still a lot of sort of pent up fiscal in the pipeline already that is sort of waiting to be spent and allocated to the economy. So that's something that could potentially, cause growth to inflect as well. And again, that's not our base case scenario, but I'm just sort of outlining all the core tenets of the bull case scenario, why I think markets have recovered so aggressively off the June lows. Now, again, if we had all these data points in hand, we would have obviously done a better job positioning for them, but it is what it is. We just have to focus on the next play. And then the last scenario, which I think is, again, just as credible as the other two, which is this breakdown in inflation momentum that we just saw is not persistent. And we really struggled to get well below, kind of high threes, low fours from the perspective of annualized core inflation momentum. And that to me is really scary, because it probably means, this is a Fed that, at least at face value, just taking their words and take their words for it, can and will tighten us into what must be a significant slowdown, just given the structural upshift in the inflation. Again, they're going to try to beat us back to 2% inflation in that scenario, but clearly the dynamics, and underlying inflation momentum are preventing that outcome from happening. So ultimately, they just have to do a little bit more tightening than was not a little bit, a lot of bit more tightening than what is currently priced in. So, as I mentioned, again, that distribution is very flat and very wide. And so I think from a portfolio construction perspective, I don't think it really favors leaning too far into the wind on one of those scenarios right now. Because again, I don't know that we have enough data and enough ability to forecast kind of which is the path of least resistance and ultimately the most high value path to take.
I just want to pick up on something that Jim referred to, and this is this political correctness of central banks. And I just wonder at the moment when I look at things is that there are a lot of things happening in the world right now, both from the war in Europe, but also in terms of the still the fallout of COVID. And I wonder if the Federal Reserve, that to some extent, even though they probably wanted really low interest rates, ultra low interest rates, we also know that as soon as they do that, they lose one of the main tools in the toolbox. But now at the moment, they actually have an excuse for hiking rates significantly to get that tool back. So I think that's one thing that we need to bear in mind. And then the other things that I think are very important, and this is what I'm going to definitely dumb down the conversation compared to you two, but when I look at with my simple view, I'm hearing people always talk about, we have to get back to, the 2% inflation target. That, by the way, this was probably picked out of thin air at some point, right? It's not really, where does the 2% come from? But in any event, it is a target that's been there during a period of globalization where we know that all the forces helped us to have low inflation and low interest rates. Now, I think the three of us agree, and certainly some of the guests we've had on this series agree, that the world is changing. We're probably already in a deglobalized world. We have a massive demographic shift, including in the US, that to me seems very inflationary. And of course, we talk about this as if inflation is the only thing that the Fed worries about, and it's not. We have unemployment as well. And I'm sitting over here in Europe, and despite all of these crises, there's no people to be found in terms of getting people back to work. Everybody's saying, we need people, and so on and so forth. I think that seems very inflationary as well. And it's going to keep unemployment rates at a level that makes probably central banks very uncomfortable in general. So I just struggle in general to see how we should even be talking about getting back to what it used to be, because I think the world has changed. And if we believe, certainly I do, that there is something called the 40-year interest rate cycle, well, we have a long ways to go. And we shouldn't even worry about getting back to really ultra-low rates for now. And actually, we just released yesterday, I think it was, an episode which I really encourage people to go and listen to, with Edward Chancellor, who just released this new book, The Price of Time. And he's probably one of the leading financial historians, especially when it comes to interest. And he doesn't see a bright future for those who are hoping for low interest rates. So I just think it's interesting. I'd love to hear how you, maybe in your work, factor in things like demographics, factor in things like maybe unemployment, and some of the structural changes that I think we all agree that they're out there.
Yeah, so great question. So very, very, I think it's extremely important to factor in not just sort of like these longer term trends, but understand exactly, how to use and weaponize those longer term trends into your asset allocation. So we have this thing called what we call our 4 horsemen of economic risk at 42 Macro. There's, politics, leverage, balance of payments, and demographics. And demographics is very much one of them. We sort of look at demographics through the lens of the working age population growth relative to the old age dependency ratio. And, one thing that is pretty clear is that, we're obviously, we have a little bit more working age population growth than kind of the rest of the developed world, certainly relative to places like China, et cetera, on a 5-10 year forward basis. but our old age dependency ratio is really starting to rise. And that's not, that's consistent across much of the developed world, including in China, where we had a significant amount of kind of globalization and tapping into their underutilized labor resource. All that's sort of changing in the sense that, this structural decline we've seen, looking at the U.S. statistics in isolation, this structural decline we've seen in the employment to population ratio, labor force participation rate, which, by the way, didn't start with COVID. It's been trending lower since 2000. It's only going to continue to decline. And so companies are going to increasingly be sort of, increasingly find it scarce or find it difficult to meet production targets, et cetera, in this world where people are aging and leaving the workforce. And you can make the case that there's, for political reasons, maybe not joining the workforce with the same kind of fervor that, you might have done that in recent decades. So I think going back to the question on interest rates, I mean, this boils down to the fact that, some people believe that, inflation is purely a monetary phenomenon. I think, just living through the pandemic and seeing what happened in inflation, it's not just a monetary phenomenon. It's a fiscal phenomenon. It's a resource scarcity phenomenon. It's a bunch of different phenomenons, which is why our secular inflation model has 16 different variables, 16 different key variables to help guide the output of that model. Again, I don't think the model is the letter of the law. If we're having this conversation, 8-9 years from now, that we actually nailed it to the decimal place. But I do believe directionally, it has proven directionally accurate, and I think it's likely to continue to prove directionally accurate in terms of the kind of the change in all those different variables. And so ultimately, we're talking about a time series that, instead of making lower highs and lower lows on inflation and by extension interest rates, we're going to be making higher highs and higher lows. It's still going to cycle. We're still going to have a Federal Reserve that responds to inflation being too high or too low, or employment being too tight or too loose at various stages of that process. But ultimately, the direction of travel is higher. And I think the starting point of this kind of 60-40 allocation, which is very popular across not just the institutional investment community, but obviously the retail investment community, that's probably wrong. We probably need to make space for, something that looks more like a 60-30-10, whereby the 10 is physical and digital commodities. Now, I'm certainly not going to get on the podcast and tell everybody to go buy 10% Bitcoin allocation, but I do believe that, things like Bitcoin, things like gold, things like physical commodity baskets will have a pretty important place in investor portfolios in this coming decade. Again, this is a decade we're exiting that looks a lot like the kind of 90s, where everyone's long U.S. stocks and tech stocks and bonds and things, all that stuff was working, but we're just in a different era. And I think it's going to get increasingly proven once we get to the other side of this Fed tightening cycle and economic cycle, and the dollar starts to decline.
I thought you were going to say the 10% was going to be trend following and volatility investment strategies.
No, I very much agree. I very much agree that alternative asset allocations and alternative investment managers is part of that bucket. Again, you're not going to, again, I agree with that. And I always mispronounce his name. So forgive me, Mr. Ilnanen, Ilnanen. Terrible pronouncing. Ilnanen. It's a really difficult name.
Ilnanen, yeah.
Yeah, I very much agree with him that the starting point of valuations renders this concept of beta, more or less dead. Like, you got to go find this is an alpha generators market, and will be an alpha generators market for an extended period of time. And I think it's going to be one by one, we're going to be convincing large institutions and large swaths of retail investors that is the case. What we experienced in 2001 and, obviously throughout the 2010s decade is going to increasingly be proven to be something that we're not getting back to.
I want to dive in here because I think you really highlighted a point that I think we all talk about it from different vantage points. And I think that's this idea of factor correlation, and the idea that we tend to get clustering of things in a similar direction when things happen. If you listen to the media, or even most kind of wealth advisors out there, people, and even the Fed, you segment every factor on its own, and people seem like they talk about the war in Ukraine as a idiosyncratic factor, right? Something that kind of came out of nowhere. But and there's lots of other things, slowing of growth versus value, and what that means in terms of money supply, protectionism, deglobalization. fiscal policy. These are all, to most commentators, separate things. But we've seen in other periods these things clustering as well. I think I'd like to highlight, the military, conflict and increasing likelihood of that, for example, which people think is completely unrelated to some of these other things going on the money supply side and inequality side. And I'd love to hear your thoughts about how you look at kind of correlation and factors, and how they cluster. Obviously, historically, if you look at, periods of higher inflation, we have geopolitical stress. We also have much higher volatility in FX, which creates dollar-denominated debt crises and also issues there. We also tend to see periods of deglobalization and protectionism, right? All of this, in my view, and I think the others, would agree with this, tend to be driven by the fact that during times of populism and building of people, and solving inequality within countries, we begin to look competitively at the world and say, we go from a cooperation game, I like to say, to a competition game. And that's simple change, which seems very overly simplistic, but it's incredibly important. It's this idea that we're trying to make do with the best we can because we can't all grow together, right? That idea can lead and does historically lead to global conflict. We have, again, we're seeing it now, and it's not just Russia, Ukraine, it's China, right? And everything that's going on there. And it's also, every single piece within a country. We're seeing the greater kind of internal strife in the U.S. And a lot of other countries as well. So again, people think of that as a separate factor. I'm using that as one example. So we get a lot of these clustering of factors that all tend to lead to the same direction when they happen. This is why we get 40-year trends. This is why we get big, longer cycles. How do you look at that? And what type of things do you put into the portfolio or suggest to deal with these changes in correlation and clustering among factors? I'd love to hear your thoughts.
Oh, if that's not a loaded question, then there's never been one before.
That's all I do is just
you're very good at that, my friend.
No.
So I'll start by saying 100% agreement that inflation tends to be the underlying driver of a lot of political dissension, discord, both within societies and across societies. Peter Turchin has a great book, Ages of Discord, kind of on this topic and how inflation, inflation episodes have historically contributed to, kind of toppling regimes and breaking up societies, et cetera. So I tend to, lean on works like that to support, what I'm about to say, which is, when you have a scenario where, if you look at the US, for instance, we have a very, sort of our Gini coefficient would tend to suggest that we have a significantly much more wealth inequality and income inequality in our society relative to, kind of Western democratic societies. And then you look at something like our employment to population ratio for prime working age individuals. By the way, these are two factors we use in our politics risk in terms of the four horsemen of economic risk. You look at those two factors and you marry them together, it's very clear that the U.S. is on its own with respect to the kind of political risk, the populism risk that we've seen. And this has been the case, obviously, since the middle of the last decade, which is part of the reason we saw a populist, take power. And, I wouldn't necessarily say Biden was a populist, but he certainly leaned in that direction during the campaign season. So now we're 2 for 2 since, kind of getting to this place where the inequalities in the system and ultimately the kind of the decline in the economy that produced that outcome from a employment to population standpoint are really contributing to this populism. I think it really boils down when you mentioned something about this sort of the mood shifting from collectivism to competition. I think that really is boiled down to a scarcity of resources. And that's kind of what inflation ultimately is boiled down to. It could be a scarcity of resources relative to the total amount of money that was printed, or it could be a scarcity of resources relative to we don't have enough stuff in the ground to feed ourselves or propel our jets or et cetera, et cetera. And so, or we don't have enough workers and bodies, able supply of labor to create enough of goods and services. And so at the end of the day, there's many things that cause inflation. The problem when you get to these inflation episodes is those many things tend to boil up all at the same time. You have an energy shock. you have a labor shortage, you get, et cetera, and all these things tend to boil together. So, I think I would be very much in the camp that, as long as we as long as we stay in this regime, we're going to be dealing with higher degrees of political volatility, higher degrees of economic volatility as a result of that. And it doesn't not all has to be bad, right? We got political volatility and the fiscal policy volatility in 2020 and 2021 that was extremely positive, right? Like that's kind of the nature of populism, is people tend to get what they want when they're in democratic societies. So you should all expect the fiscal policy sort of reaction function in this higher inflation decade to be higher. And don't forget, one thing we haven't talked about as a finance, kind of talking head consortium, if you will, is the concept of the four-turning, which, by the way, hasn't gone anywhere. We're getting deeper and deeper into the four-turning, and shout out to my former colleague Neil Howe, who's sort of seminal in helping create that work. We're getting deeper and deeper into the four-turning, whereby we're going to start to see the revolutions of this kind of political volatility swing back and forth until we ultimately try, to one side, whether it be the far right or the far left, kind of takes power and ultimately kind of gets to wield the entire power of the government. So that's going to be fun to live through. I wish I had a better, more positive message, but I guess the positive message is, this isn't the first fourth turning and won't be the last. This isn't the first decade where the stationary mean of inflation rises instead of falls. It won't be the last. This won't be the first decade where the Fed might look like it has no idea what it's doing on monetary policy. It won't be the last. So at the end of the day, we're all going to be fine. And as long as we understand that, there's different cycles from an intermediate term perspective that we can take advantage of to sort of extract the beta that is there and available to be extracted from financial markets. We can definitely do that along the way. And then when there's no beta to be extracted, or you're in these more difficult, volatile parts of the market, there are guys like you, Jim, and Niels, to take advantage of from the perspective of alpha generators. It doesn't all have to be bad. We just have to accept the fact that the distribution of outcomes has changed both cyclically and structurally.
Yeah, I mean, speaking of that, and I hope you're right that we're all going to be fine at the end of this fourth turning. I do find it interesting that so many people managing so much money, many of them have never, done so through an inflationary time. So, I really do worry about some of these portfolios. And speaking about portfolio, I do want to touch, before we start to wind down, I do want to touch a little bit about portfolio construction, because here's another thing that I wonder in my kind of dumbed down way of looking at things. And that is, a lot of these models that we still refer to were, created 50, 70 years ago. In a very different environment, in a very different world economy. And I wonder if we can still rely on them as much as we do, whether that's something you think about, whether that's something you take into account. I mean, I'd love to hear how you think about portfolio construction, but also, because you mentioned this, kind of the role of the risk management, and can we still rely on what we thought of as safe assets as being safe? I mean, we have very prominent people out there talking about sovereign debt crises, et cetera, et cetera. So I just want to sort of jump in that direction before we have to jump, so to speak.
Yeah, so I really appreciate that question, because that's something I'm very passionate about. Certainly, we spend a lot of our energy and efforts at 42 Macro and trying to help investors be more thoughtful about portfolio construction, which I find to be kind of kind of like the Wild West still, if you will. It's kind of one of the it's one of the least studied and agreed upon kind of things that we do in our industry in terms of institutional finance. So, I think let's start with the kind of what I think are the basic building blocks. And again, none of this is academic at this point yet, but I think from the perspective of trying to construct portfolios, you need to sort of diversify, across not just investment horizons, but also investment catalysts. You sort of, I think that's kind of the first mistake a lot of investors make, is to sort of, hey, I think all this is going to happen at one particular point in time. Therefore, I'm betting on, this one thing or series of things happening at this one particular point in time. I think you need to be a lot more thoughtful about using the various investment horizons to your advantage. I think we also need to acknowledge that, there's always a range of probable outcomes to take advantage of. It's not just one outcome, your base case scenario, you need to be acknowledged and fluid and flexible enough and data driven enough, in my opinion, to acknowledge that and position for, various tenets of the bear case and the bull case scenarios, that are on the sides adjacent to your central thesis. And then lastly, I think it needs to be quantitatively driven. So we think about the world through the lens of, annualized expected returns from the perspective of our back test, percent positive ratios, volatility, and covariance as kind of like the latter two being kind of the building blocks of understanding risk, and the former two being the building blocks of understanding reward. And when you put all those different factors together, the diversification across times and catalysts, the kind of acknowledgement and positioning for the full range of probable outcomes, not just your base case scenario, and ultimately doing that with, different understandings of how things have historically traded with each other, asset classes and factors with each other across history is very important. Niels, I think you bring up a very good question about sampling, which is, we've lived in this very disinflationary era, and a lot of the indices we would use to construct backtests to understand some of these quantitative dynamics don't go much further back to allow us to understand, kind of how different factors would have correlated or the volatilities of different factors in various regimes. And so it makes that aspect of it challenging. And then there's also other data sets that go back, 100 years, for instance. One of my favorite people from my time in New Haven is obviously Professor Schiller. And you download his data set and you got interest rates, stocks, everything you want, back all the way to the 1870s. And so the reality is, another problem with sampling, and I'm going on a tangent, but you go too far back in the data and it stops making sense. And so where do you draw the line? I mean, that's kind of something we all, as folks who've programmed models before, understand that that's one of the many challenges of programming models on both the in and out of sample basis. But kind of just getting to the meat of it all, I think from a top-down strategic asset allocation portfolio construction perspective, we need to understand that, again, we're moving into a world that is a lot less monolithic from the perspective of the range of probable outcomes. We've been in this very disinflationary world. We've been in a world where the Fed has been incrementally easier at every slowdown in growth relative to the prior slowdown in growth. And this is probably not going to be the case in this decade. There's going to still be tightening and easing cycles. There's going to be, inflationary upturns and downturns and growth cycle upturns and downturns. But we have to acknowledge that, it's not going to be, again, that the direction of travel for all those indicators is just not going to be straight down or straight up in terms of the Fed balance sheet, et cetera, et cetera. So that, from a portfolio construction perspective, requires investors to acknowledge that and start to have a lot more balance than they've probably had in recent years and decades. I mean, quite frankly, if you own 5 stocks and nothing else in the last 5 years, you're probably not even listening to us. This is probably not a very interesting conversation. But the reality is, that's probably going to be one of the worst positions you could possibly have, certainly on a relative basis to a lot of other outcomes from the portfolio construction perspective in the coming 5 years. So that, again, I want to stress to the listeners that, we're using a lot of big words and processes, but the reality is, I don't think we know. I don't think we have the right answers. I think the most important thing we can do is just be humble and Bayesian about this entire process and understand that, hey, we're probably going through regime change. Some of the things that we're used to doing are probably going to continue to work. Some of the things that we're used to doing are probably going to stop working. But it's very important for us to be very, present and open and honest about that process in real time, so that we can do less of what's, going to stop working and do more of what's going to continue to work. So I think that's kind of, if I have one key takeaway from this discussion, it's definitely that from a longer term perspective.
Now, if I didn't know better, I would say it sounds like trend following, but there we are, Darius.
Jim, I just heard long haul. It's weird.
It's funny how we hear what we want, right? So anyways, I want, Jim, you final question, final thought before we start to wind down, because I know we have a hard stop today, and we definitely want Darius to come back later on in the year to tackle some of the things we didn't get to and where we're heading. But anything you want to sort of...
Yeah, less of a question, more of a just general comment. And to pull on what he was just saying, I think prediction is very difficult when we think of it as predicting a certain outcome. I would agree with that. But I think where prediction is incredibly powerful and people, this is relatively well documented, is understanding the distribution and what's what kind of distribution you may be in or may not be in. And that's a very different type of prediction. I think most people's brains, when they say prediction, say, what's going to happen? Are we going up? Are we going down? When are we going up or when are we going down? But being able to predict, more leptokurtic distribution, to use that word again, like a fatter tails or something that's narrower, a period of calm, or again, wider distribution that may be right leaning, left leaning. Those things are actually quite a bit easier to predict from a probabilistic perspective. And I think, not that anything's easy in life, but that tends to be the case. So I think that's broadly, I think that's what you're saying broadly, I think, is if you take that approach over the long run, you should have some edge, you should do better. And I think things like volatility, which is not directional, things like trend following, things like your approach, right, which is really very probabilistic, really tend to have an extra layer of edge. And I really think, especially in this type of period where things are less linear and more non-linear, I think that these types of processes become much more powerful and important.
Absolutely. Darius, this has really been an awesome conversation with so much knowledge that you shared with us. So thank you very much for doing this today. Of course, everyone listening today should go and follow Darius and subscribe to the great work they do at 42 Macro, where he's very generous when it comes to sharing content that you and you can, of course, find the links in the show notes for today's episode. Because as you can tell from our conversation today, we are living in a true global macro-driven world, and it is perhaps more important than ever before to stay well informed. From Jem and me, thanks so much for listening, and we look forward to being back with you as we continue our Global Macro series. In the meantime, take care of yourself and take care of each other.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.